Well, hello, I'm Chris McAlpin with Sound Financial, and I hope you're doing well. And I know most of you, and I get tickled kind of introducing myself, I guess. But wow, what a crazy start to another year, and what a tough start to the year. In January, the stock and the bond markets tried to price in 4 to 7 interest rate increases for 22 by the interest rate increases by the U.S. Federal Reserve, which the Federal Reserve is the United States' central bank. And they've determined that they're going to fight inflation this year. And so rising interest rates, a slowing economy, inflation issues, this has been really the focus that we've been looking at, expecting all through 2022. And it's certainly caused a lot of market volatility, caused a sell-off in January, caused a lot of political theatrics, a lot of Fed speak, and everyone trying to figure out what's going on. And now, at the recording of this, Russia has now invaded the Ukraine, started a war in eastern Ukraine, and it gives someone a lot of reasons to look at the world and be worried. I can certainly understand a person just saying, "Chris, this place is on fire, man. What do we do?" I get that. I fully understand that feeling, and especially after 2 years of a global pandemic, a lot of time being quarantined, a lot of people having to stay home for a lot of different reasons. I understand that a person can just look at the world and be sick and tired of being sick and tired, and then you open your investment statements from January, and you're disappointed. And quite frankly, you're probably going to open them from February and be disappointed as well. And so what do we do? What do we think about? Because when it comes to your money and it comes to investments, decisions matter. How you make decisions matter. The facts matter. Data matters. And so think about this. The US stock market, as of when I'm recording this, is at negative 12% year to date. Which is a standard correction. And I say standard because historically, the markets go through a 10% correction nearly every year. I remember 15, 20 years ago, we could go, the markets could lose 10% over 6 to 8 weeks and no one even noticed because it wasn't all over the news. It wasn't on our phones. We didn't have these reports at the tips of our fingers. And so a lot of times, we get a lot of this information and we're not really sure what to do with it all. And I believe that that's a part of our worry. And I think there's two things that are weighing on our worry these days. Number one, it is that we have too much news. And I put that in kind of air quotes, that too much news, because we see all the bad things in the world and we're very worried about the bad things in the world, but we don't have a filter to think, all right, this is how it applies to my life. And certainly, and I'm speaking about money, how does this apply to my financial life? And I don't say that in any way being flippant about what's going on in the Ukraine. I hurt for the people there. I hurt for the people in Eastern Europe. I hurt for what's going on. But we do believe that the U.S. stock market and bond market has entered into an oversold space, and we expect a bounce. And we expect a better half of the year, better second half of the year, because inflation and interest rates are still the main story. And that's number one. So much news. Number two, I think that we're all of us, me included. We're tired, we're stressed, we're kind of worn out. Even the most optimistic of us have found some chinks in our armor here in the last 3 to 6 months. Then we turn on the news channel in the morning, and all of a sudden, wow, we got another big event to be worried about. So this is what we're going to do. This is what we're going to do at Sound Financial, and this is what we're going to do with you, okay? Because we all recognize that when we're stressed, we still have to make high-quality decisions. We want to look at the facts. We want to go back to our research. We want to look at the data. And so therefore, just in this little bit of a talk right here, I want to give you a hypothetical investment model. Just a hypothetical 60% in the S&P 500, 40% in the Barclays Ag, which is a bond index. All this is readily available data. I'm using this from our data from Bloomberg. Since 2008, so this is including the Great Recession, This is including half of one of the US's longest wars ever. And this is including a global pandemic. So average returns of this 60-40 model would have been about 9.2% a year. That'd be great. I think most retirees would be excited about that. I think most investors would be very pleased, especially considering all the ups and downs of those last 14 years. But that model right now is probably down 7 to 10% at this moment. Okay? And we can also look into history and we can look at a handful of years. 2018, where we had rising interest rates and a slowing economy. 2014, the last time Russia invaded the Ukraine, when they invaded the Crimea. 2001, when the United States itself was attacked. 1991, when the Soviet Union fell, when it collapsed. And I'm going to use 92 because that happened at the end of 91. So those 4 years, using those 4 years combined, the average return of that 60-40 model would have been about 6% in those 4 years. Some pretty catastrophic events. And the market responded in really nasty form for a few days, few weeks, even a month or two afterwards, but then it grew out of it. And I'm not in any way predicting that's what's going to happen, but history points to that being a likely conclusion. And the reason I can't predict that is that I can't predict the future, okay? And you know that. We know we can't do that. So what can we do? What can you and us do together? And this is what I'm going to ask you to do. I want you to talk with your advisor, ask your advisor, say, let's look at my models, tested returns, and statistics, okay? We can look at historical data and determine within a 95% accuracy an expected range of returns. And this is using statistics, looking at the past, attempting to predict the future. It's not always exact, but it can give us a high likelihood. And what I want you to do most with that is take that likelihood, look at that model, look at the ride, okay, the ups and downs of that investment, and determine two questions. All right. Will this help me reach my financial goals? And can I ride this ride? Because it's going to go up and down at times. You see, the best we can do when we look at this crazy world, okay, the best we can do in managing investment money is just look at historical stats, historical data, because I'll get the question, if you expected this to happen, what can you do? Because we can't predict the future, I can't say that I expected something to happen or not happen. This is why we'll use this rules-based approach. It's math, a lot of data, put them together in a formula, and come back with some expected outcomes. And I tell you what, I think it will do an awesome job for you in helping you reach your goals. You have been tremendously blessed. We're honored that you trust us to help you manage your financial future. We appreciate that deeply, and we don't take that trust lightly. And I look forward to talking to you soon. Take care. God bless.